Spotify entered the public market on Tuesday, and the Swedish music streaming service chose an unusual way. It opted for a direct listing, meaning instead of issuing new shares, it's selling some of its existing stock. But it may not be the best time to be listing. On Monday, major stocks tumbled as trade tensions between the US and China heated up. China has imposed retaliatory tariffs on $3 billion worth of US goods. And while investor concern over a trade war with the US's biggest trading partner is growing, President Donald Trump has also picked a fight with the US's largest online retailer.
Only fools or worse are saying that our money-losing post office makes money with Amazon. They lose a fortune, and this will be changed. Also, our fully tax-paying retailers are closing stores all over the country, not a level playing field.
Amazon shares fell more than 5% on Monday, leading an overall tech sell-off, with investors fearing tighter regulations. Electric car maker Tesla suffered losses as the company fell short of its Model 3 delivery targets. Facebook shares slumped due to its widening data scandal. And Netflix and Alphabet dropped between 2 and 4%, with the so-called FANG stocks wiping out nearly $80 billion in total.
It's the continued implosion of the FANG stocks, partly due to President Trump's tweets, partly due to what we've seen out of Facebook. But I think more importantly, what's happening is we're entering a risk-off mode. Last year was clearly a risk-on mode where nothing phased investor confidence. But this year, things are starting to impact investors. I think the market's starting to realize that you can lose money in stocks. And so, well, last year we were constantly buying the dip. This year we're selling the rebound, and I think that's a large part in what's happening today.
Spotify's first day on the New York Stock Exchange will show just how much investors are ready to risk in a volatile market. Laila Humairah, TRT World.
So for more on where the global markets may be headed, let's bring in Jasper Lawler. He's the Senior Market Analyst at London Capital Group, and he joins us from London. Jasper, great to have you on Money Talks once again. So look, we've seen a bit of a rebound on the US markets. Looking at all of them now, they're up between like 0.5%. The Dow up about 8.8% at the moment. But what's the mood like on European trading floors and in London where you are?
Well, good evening. The environment that we're in at the moment in Europe, I think, is largely mirroring what's happening on Wall Street. So when sentiment was looking very dire on Monday, we had a big drop on Wall Street while European markets were closed for Easter. Subsequently, it was going to be a pretty tough day for Europe. But actually, as it turned out, we saw that the rebound was taking place on Tuesday on Wall Street. And I think there's a few things that maybe insulate Europe from some of the big fears that the market have right now. So actually, the kind of declines that we're seeing on Wall Street are not being entirely replicated here in Europe. We're not the direct target of Trump's tariffs. It looks like he has China solely in focus there. And Europe doesn't have as many technology companies typically in our benchmark stock indices. So when technology shares decline, it doesn't bring the average stock market price down as much as it does in the US. So those couple of things have actually helped keep Europe afloat.
So looking at the US, look, the markets over there, they seem to get spooked almost every time there is a move either by the US or China. Are they overreacting to this whole trade dispute, given the amounts that we're talking about? I mean, $60 billion on one side, $3 billion on the other. It's a drop in the ocean, really, isn't it?
I completely agree with you. The figures that we're currently talking about are drops in the ocean. But I guess what the market is pricing in is where this could go should it become a kind of tit-for-tat trade war where the US responds to China's reaction and China responds to that reaction and so forth, and things quickly escalate to much larger numbers. And so that's what the market's pricing in right now. You do typically see overreactions in markets, and it's obviously a very touchy environment right now. So our default expectation here is that actually the US and China do come to some sort of negotiated settlement here on trade, where China opens up its markets to some degree on the intellectual property front. There's already been talk about allowing more US firms to sell semiconductors in China. So some of those kinds of things can basically give Donald Trump a win just as he heads into the midterm elections in the US. And I don't think it's probably in his interest, and I think he probably knows it's not in his interest not to bring about a trade war just as an important election's coming up in the US.
Yeah, so Jasper, talking about Donald Trump and overreactions, let's look at FANG stocks for a second. So he opens up his laptop or whatever his preferred tweeting mechanism is, and he wipes out $78 billion from the market value of FANG stocks. Is that an overreaction on the part of the markets as well?
Quite a powerful tweet, isn't it? For sure. I think there's kind of two parts to this technology sell-off here. One is that there are some genuine concerns now that actually the very easy time some of these technology companies have had in terms of a very laissez-faire approach to regulation, particularly in the US. Maybe that era is coming to an end now. So obviously the focus at the moment has been Amazon, and Donald Trump does raise some interesting points about how level the playing field is between these online retailers, which often pay a lesser rate of tax, versus the traditional high street retailers, which are really struggling across the developed world at the moment. And so that change to an environment of higher regulation is a concern. And then the other aspect is that these companies have been leading the market higher for so long that now there's a sign of trouble on the horizon for the broader market. They're leading the declines.
We're almost out of time, Jasper, but a quick final question. With the sell-off that we've seen, has it uncovered any gems that are looking a little cheap right now?
Well, I think sticking with this theme of Amazon, should Donald Trump and the US administration and maybe other nations across the developed world institute some tighter regulation, then actually that brings you back to the retail sector, which has been really badly beaten up and is one of the very few areas of value. If Amazon's curtailed a little bit, traditional retailers stand to gain from that.
OK, fantastic. Jasper Lawler from the London Capital Group. We'll leave it there. Thank you.